Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenborg.
Because it's not how much you make in the markets, it's how much of that you can keep.
I had a client reach out to me just recently, and he said he's about to retire, that he's kind of had it with the corporate world. So he said, I'd like you guys to do a retirement planning schedule, and I'm interested in maybe a dividend strategy for income. Now, we're a full-service wealth management firm. I'm Todd. Todd was a former practicing CPA and is CFP, and I've done a lot of I've got a CPA background, never held my license out, but I passed the exam and did all the stuff to qualify, but I didn't want CPAs thinking I wanted to steal their business because I'm not going to do your quarterly tax returns. I do the bigger picture. And then I'm a CFA, but we've got a lot of deep planning, whether it's irrevocable trust, revocable trust, whatever you need. We are a full wealth management firm. I don't talk about it because it's boring. And everybody just wants to hear about what the next hottest stock is or how to protect their portfolio when it gets ugly. They don't really, a lot of people don't even do estate planning or retirement planning till it's time, right? A lot of people in our own office probably guilty of that. And that's just human nature. But getting back to his comment about I wanted a dividend strategy in retirement. So look, I don't care if you call it income, royalties, capital gains, it doesn't matter. That's just for the IRS to figure out what your tax rate is. If it's income, if it's long-term capital gains, short-term royalties, whatever, and whether it avoids Social Security, Medicaid, it just gets complicated. Folks, it's all about the cash flow, okay? It's all about the net to you after fees and taxes. So if you have that dividend strategy, say you get a 4% dividend, kind of average, it's kind of high in there right now, most are a little lower, but let's call it even a 4% dividend, and that stock goes down 25% that year in an ugly market, did you make money? Or at least protect your portfolio? No, you're down net 21, and you have to pay the tax and the dividend if it's in a taxable account. So you got to get out of that kind of thinking, because most dividend strategies, or even the what is it called, covered call strategy, right, to enhance the income. It's really short-term capital gains if it works, but those strategies, if you're going to buy and hold, because if you don't hold them, you may not get the dividend. You may miss the dividend date, right? But the point is, if you do that, you're still at risk for a large drawdown during the bear market, because that pie charts are us. Modern portfolio theory is nonsense and, well, BS. Anyway, the real science is sequence of returns. If you don't know what that is, Google it or look it up on AI. In any event, if you're going to make 7 or 8% on your dividends strategy, with the stock appreciation, dividends, whatever. But another strategy that doesn't have dividends still has some short-term capital gains and some long-term. Torbottection is approximately 60% short-term capital gains and 40% long-term. And we hedge the long-term so we can make them long-term, right? But if you're making 12, 13% annualized, right? And even if you pay the tax, it's still a higher return, more money, more cash flow, and you don't have to get creamed in a bear market. That's my opinion. And Don and I, the two principals of the firm, we have virtually all of our money in these two strategies, Torbottection and Turbotection. We've got a few little side accounts that we're doing beta test portfolios, because we're not going to put your money at risk until our money's been at risk and we verified it. Okay, so with the exception of maybe couple $100,000 of, test portfolios, we've got all of our skin in the game. Anywho, just food for thought. I'm going to go to the mailbag, and then we're going to go right to the team. So this is one mailbag. MB, he's a client. He's been a long-term client. He likes us a lot, and he's got this AI, what do you call it? Thumbnails. Zach's our producer. Thumbnails that makes these thumbnails, and he loves being creative now. He's retired, so he always sends us these, and they're great. I love them. Thank you, MB. On March 30th, the index is, these are his notes, by the way. On March 30th, the index is bottomed out. The year-to-date percentage loss were negative 3.35 Russell 2000, negative 6.22 Dow, negative 7.33 S&P, negative 10.94 NASDAQ. Revere's based rule strategy, limiting my Schwab account max loss to 4.5%. Okay? Show them that thumbnail, Zach, would you? Negative 4.54% Grotection plus Turbotection. And he said, you have always emphasized that Revere's goal is to smooth out the volatility in the accounts. Folks, it's not about total return. It's about total risk-adjusted return. How much risk did you get to earn those returns? Because if you get a huge drawdown, you don't have to go change your underwear at Revere, okay? It doesn't scare you out of your strategy, because even though you say you're aggressive or you got an aggressive posture, right? Your risk tolerance, everybody's got their pain threshold. Some people, it's the people that have a low risk tolerance, maybe 10, 15, 20%. But even the aggressive ones at 30, 35%, they'll say uncle. And normally that's the worst time to sell. You should have sold a lot earlier, by the way. That's what we do. We get defensive. So you got to put your emotions out of it, and you got to use this is statistics, law of large numbers, and probabilities. So now, he said, you've always emphasized that Revere's goal is to smooth out the volatility in the accounts. You certainly demonstrated that in this year's sell-off. As a result, I was able to sleep at night. Swan, that's what we call it in-house. Swan, S-W-A-N. Sleep well at night. Thank you. And then, Ted, show the other one. Turbotection blasted off Thursday with a 2.58% gain compared with NASDAQ's 1.03. This is truly impressive performance. Once again, Turbotection is kicking butt. Keep up the great stock picks. Now, this is my comment. Now, this doesn't always happen. Like yesterday, Turbotection underperformed the markets pretty decently, right? But that's one day. Over time, little by little, I mean, they're more often than not, they do better, especially on a risk-adjusted basis. Because remember, if you're just in the NASDAQ or the S&P or indexes, right, or just buy and hold, you're driving a car with no brakes, right? Anyway, I've said my piece. Now, Don, the Jedi Master Don, Obi-Don Kenobi, is not in studio today. He actually had some family commitments he had to take care of. And so Ted is going to lead the review. So Ted, take it away. And like Paul said, don't let me down. Actually, that might have been Harrison. I think he wrote that song, but go ahead.
As Don says, we have the B team here today, except this time we have Dan. So maybe the B plus team.
I'm the C team. I'm the C team.
We got the C team here today. So yeah, we'll have 3 great segments today from Connor, Jackson. Welcome to the pod, Jackson. And then finishing up with Todd. But before we start, let's just do a quick overview of the indexes. Just a general, inter-asset correlation that Don does, and then we'll send it over to Connor to talk about semiconductors. So yesterday, we're at some pretty extended markets right now. S&P yesterday was about 7-8% extended above the 50, about 7 ATR. And then the NASDAQ,
average to range,
over 9-10 x ATR above the 50 and over 8% above the 50. So in these territories, we start to expect a pullback. And it looked like we started to get one yesterday. We reversed, closed at the lows. Part of that reason was the U.S. started firing some more missiles at Iran, but Trump quickly clarified that it was not a breach of ceasefire. That led to a bid after hours yesterday, and today we're straight back up into new highs. We're really just in what we call a power trend, and we're not going to get to the specific definition, but it's essentially when the 21 EMA is over the 50, we have many days up in a row above those two moving averages. And what it tells us is we just have to have a bull bias until the power trend ends. This is a classic lockout rally. We had the V-shaped recovery after Trump announced the ceasefire. Now they're working on the peace proposal, and we're just trending nicely above the 8 EMA. We had a couple taps against the 8 EMA, but so far we just continue higher from here. Although yesterday we were only, let me get the select chart up. Although yesterday we only down 38 basis points in the S&P and 12 basis points in the NASDAQ. Under the hood, higher beta momentum names were kind of crushed in a way. There's definitely momentum unwind yesterday. For example, ARM, which we have in Turbo, was down 10% on earnings. BE, without any news catalyst yesterday, was down 9.4, and we can go on and on. AMPX was one as well that we had into earnings. It was up 15%. It was 1.5x the implied move, so we decided to hold into earnings, and that took a dive on us. We closed it down about 20% on the day, and we had a lower cost, so it ended up being a smaller loser, but a lot of open profit and loss given back there. And we can go and talk about more of the high beta names, but the bottom line is yesterday, the indexes masked a lot of the underneath damage in typically the names we traffic in, the growth and momentum, high beta names. And a big reason from that was the MAGS make a new all-time high today. It's actually green yesterday, up 63 basis points. That is the Mag 7 ETF. And we saw NVIDIA act strong, Google, and some of the other ones too. So quickly looking at the RSP, you can see it is lagging the S&P 500. It is building a cup with handle though, so we would love to see this breakout, and that would signal to us the rest of the S&P 500. Maybe the S&P 490 is also participating with the mega caps. And then the Dow also hasn't made a new all-time high yet, despite the S&P and the NASDAQ making a new all-time high. Mid caps, we did breach into all-time highs 2 days ago. Yesterday, we reversed back in, and then today we're trading a tight range within yesterday's candle. Still looks good. Looking on the weekly, this is a little distorted. Give me 1 second. You can see just this huge range out here, and we're heading into highs from there. And then finally, small caps as well. Also into new all-time highs this week. Looking at the daily chart, 2 days ago, it made an all-time high. Yesterday, reversed back in, but we're still trending above the 8 EMA. And as long as we're all trending, all the indexes are trending above the 8 EMA, there's nothing too much to worry about. Except when we do get historical extensions, it is prudent to trim some stocks, raise stops as well, and maybe go smaller on new positions. So that is 4 or 5 indexes. Maybe I'll quickly touch on the VIX. We like this VIX range right here, just sitting in the 16 to 18-ish zone below 20. So volatility has definitely come down. The S&P 21-day ATR now is below 1%. So that's exactly what we want to see. We've noticed that that 1% level often can be a gauge for healthy markets versus unhealthy markets, especially the trend of the 21-day ATR on the S&P 500. So we potentially entered this breakout rally, low volatility environment where our stocks can trend, and this is where we really do well as trend followers. Maybe I'll touch on gold, silver just real quick, and then I'll send it over to Connor to talk about historical extension in the semiconductor sector. Gold, there's not too much to talk about, just still below declining 50, just meandering around. Same with silver. It's starting to form a little bit of a base, but after that huge crack, the biggest down day since the 1970s, this is probably done for many more weeks or even months. And then quickly touching Bitcoin, it is starting to come back here, reclaim that late 2024 pre-election breakout level. It's reclaiming the 821, 50, 100 day, but there's still the declining 150 and declining 200 above. And on the weekly chart, we saw the declining 30 week, which put in the highs for this week, and the declining 40 week. So the bottom line right now is we're continuing to ride the trend higher, trailing our positions, raising our stops as the markets and our stocks move higher, and just staying conscious that the markets are quite extended here for trims in the strength. And so from there, I guess I'll send it to Connor to talk about semiconductors, which has been the leading sector off the lows. Pretty incredible move. And we have seen some historical extensions in many of these names and the ETF.
Yeah, thanks, Ted. So here we have the SOXX. This is just a broad-based semiconductor ETF, and you can see quite historic move that it's been on. And basically, we're at record level extensions right now that we've never seen before, going back to inception of this ETF. Right now, SOXX, you can't see it on Market Surge, but if you have TradingView, there's scripts for it. But there's currently 12 ATRs above the 50-day moving average. And historically, if you look at, stocks, ETFs, indexes going back for years, you can see right around that 10 ATR extension is typically when something's reaching max kind of euphoria and that a digestion and pullback is likely. And that's what we're seeing on semiconductors right now. There's absolutely no doubt that they are the leading theme of the market right now. Huge fundamental drivers. But you got to be cognizant of the extension. And when something gets 12 ATR above the 50-day moving average, to me, that signals, right? If you own semiconductors, trimming into strength, and then it's really not an optimal spot to initiate new exposure. And we'll take a look at some of the individual stocks as well. So Intel's another one. And this one's even crazier. This one is 17 ATR above the 50-day moving average right now. And you can just see the incredible trend that this stock has been on. And, you want to be aware of the extension. But again, if you own a position in this stock, you just want to sell into strength and trail a position. AMD is another one. This one is 14 ATR above the 50-day moving average. If you pull up AMD, Ted.
Hold on 1 second.
And, AMD's been on a huge run as well, sitting at 14 ATR above the 50-day moving average. And we'll just take a brief look at Marvell. This one was over 10 ATR above the 50-day for a couple days. And then as price started to consolidate, this one's only 8 ATR. And that's kind of another point I want to emphasize, is that when you get these extensions, it does not mean short. It does not mean sell. It just is something you want to be aware of, because they can consolidate via time as well. And what I mean by that is basically what Marvell's doing right now. It's not pulling back very aggressively. It's just kind of consolidating, and in time the 50-day is starting to catch up to price, and then those extensions are getting worn off, and that's what we're seeing with Marvell. And again, when you have a stock like Marvell breaking out of a huge multi-year base, the bigger the base, the higher in space. So this move very well could be young, and it just needs some well-deserved consolidation and a breather. So really the point of my section today, it's very short, is just you want to be aware of the extensions, right? Maybe putting a pause on adding new exposure for these stocks. But if you own them, use it to trim into strength. And then you don't know how high these can go. I mean, these can go 20 ATR above the 50-day moving average. Sometimes when things look high, they can go even higher. And so that's why utilizing an approach of selling into strength and then trailing certain moving averages, right? The strongest stocks are going to ride the 8 EMA, can do it for weeks. And once it starts to break the 21, it's why the market just telling you that it needs some consolidation. It needs a new base. So quite the historic run on semiconductors that we're seeing right now, and it's going to be interesting, if they continue with this record of extensions.
So I wanted to jump in and clarify just one thing that he said. When he said take some profits when it's really extended, right? And then he said trail up a stop, get you out. We actually don't use hard stops because the market makers know where they are. And so we actually use alerts, and then we go sell it appropriately. But when Connor's saying that, he's saying you're taking profits on some of the position, but leaving some of the position to keep going if it's going to keep going. but you have a stop just in case. Just like the tech wreck. For those people that are as seasoned as I am, they'll remember the tech wreck, and I guarantee the ATRs was at least as high as 12 over the moving average. I mean, it was very extended, as they would say. We back then we called it a blow off top. But anyway, all right. Thanks, Connor. That was great. Back, Ted.
Yep.
Who's next?
Yep. So yeah, thank you, Connor. Great segment. Next up is Jackson. He's been obsessed with these names for a few weeks now, and he's placed some pretty big bets there and has been right so far. So we'll have him talk about 4 of these NeoCloud names.
Yeah, thanks, Ted. Appreciate you introducing me. This compute theme has definitely been something I've been focused on with the constraints, and really just wanted to kind of highlight those which had earnings announcements this week. And Ted, thank you for pulling up WGMI. As you can see on aggregate there, right, the group's holding up in the gap. Made a nice leg up the right-hand side of the base and looking to potentially break out in due time if this group is going to work all together. Moving on to CIFR, that was the first to report this week. I believe it reported on Tuesday, and as you can see, it actually reported, didn't gap, and then during the session had a big nice move through the consolidation pivot on a double miss. That said, guidance was focused around a NeoCloud shift, so shifting away from just being a lease co-located data center play to hopefully being a little bit more integrated in terms of what processes they control for bringing compute online. And they also signed a $9 billion deal with an unnamed hyperscaler. So that's the key takeaway there. Now just watching for this name really to hold the 20 level, start to build out a flag here, and then potentially go for a breakout. That's it as far as CIFR. Moving on to CoreWeave. CoreWeave is a more traditional NeoCloud name along with Nebius. And this had a material non-confirmation, big failure today with a show of significant relative weakness. Had been a big winner for us and a name that was looking really constructive, especially on a weekly time frame, taking out key resistance levels. But that reported a double miss and a backlog increase without increasing guidance. So they're not sure that the backlog, they're going to be able to keep the backlog accelerating. So that's really it there. Just goes to show how youthful this theme is, and you've got to be careful with the volatility and the high beta, high ATR of these names. IREN, bit of a different story here today, showing relative strength within the group, but a far cry from what it was doing both in the after-hour session yesterday and the pre-market. Reported a double miss that was a pretty bad miss, and out of all the names highlighted the transition risk while moving and shifting the phase of the business away from Bitcoin mining. They reported a big miss on the Bitcoin segment, down from, I believe, a $180 million estimate to only $110 million. But their AI cloud revenue, which is the segment of the business that future investors are really worried about for continued growth and for the theme to continue to build out, was actually a double there. So they went from 34 million up from 17 million quarter over quarter, and also announced an NVIDIA strategic partnership with a $3.4 billion 5-year deal for 60 megawatts of capacity, and also gave NVIDIA a right to buy 30 million shares at $70. So this name was actually gapping to $72 in the after hours, and then upon the announcement of the actual report came in. Moving on to WULF, which reported this morning and reported a double miss, but is expecting their Kentucky facility to have a deal in the near future. This name, when compared with the others, was undoubtedly the leader, obviously moving out of this stage 2 base above the green line breakout level and showing significant relative strength. Part of the core today for the, if this earnings breakout was not going to fall through, we get the failure back in and now see how it handles the pullback either into the 8 and 10 or even, a base retest from here or 21 day. But yeah, just a mixed bag of results. And with Nebius coming up next week, NBIS on earnings on, I believe it's Wednesday of next week, that will be a big tell potentially for where the group is heading and where neoclouds are heading in general. Yeah, so Ted, passing it back to you.
All right,
Thanks,
Jackson,
guys.
listen, thanks. I'd like to admit, so what Jackson is kind of saying, and I'm going to clarify this and put it in real layman, simple terms for us seasoned folks. The major themes right now in the market are the computer chips to run AI, because it takes a lot of computing power. It also takes a lot of energy. That's why all these energy stocks have also been so hot. So it's kind of like akin to the gold rush in 1949 California, 1849, excuse me. You don't want to mine for gold and pan for gold and speculate. You want to sell the shovels and the things to mine for the gold. And that's why these particular companies are doing hot. All right, Ted, I guess Todd's up.
Yep. Finally, Todd. He's going to talk about silver and then some cybersecurity names. So, Todd.
Yeah, actually, I think since you already covered silver, Ted, I'm just going to go straight into two cyber names because we had some very, very big surprises in two key names here. And the first one is FTNT, and overall, just a huge beat and raise, just clean across the board, with product revenue up over 40%, billings up 31%, when they were expecting product revenues to be up around high single digits. So it was just a huge surprise here, and it sent a lot of the cybersecurity arena up in sympathy. But this is the first one, and if we just go to a weekly, we can see how, this last earnings report has set up this nasty looking death knell that just totally came to life and got repriced. And in the midst of all this, we had software also getting repriced downwards. But this is looking like a big re-rate, and it's completely reclaimed that big gap down that Ted's pointing to, and we got a day 2 higher high. So that was just a clean beat raise and just massive announcement on their product revenue growth. So that's a name we're definitely going to be keeping an eye on, as it's in this big stage 1 base right now. The second one is Datadog, DDOG. This is the other one that's really bringing some life back to the cyber area. And this was just a clean trifecta again of a sizable beat, very strong guidance, and evidence of not only AI data center demand, but also their core regular business accelerated. So big surprise here, as AI was supposed to be taking over everything. And now you've got a big beat and inside day trading on this one too. And this has some really good numbers on top of it all. And finally, just a note, these stocks have gotten a lot cheaper over time. We talked about TWLO, TWLO, and you don't have to bring that up, but at its peak, I just went back and looked. TWLO was trading at 63 times sales back in like 2021. It's now down to 5 times sales, and before this big gap up, it was trading at like 2 times sales. So you've had just a pretty big re-rating on all these, and now finally a lot of them are just a lot cheaper. So, again, that's all I wanted to talk about today, with the cybersecurity group coming back to life with some really surprising numbers under the surface to keep an eye on. And that's it. Thanks, Ted.
Thank you, Todd. Dan, do you have anything else? We can
Well, the
start
only
back
thing
on that.
the only thing I'd like to let folks know is, look, this is a 45-minute, hour-long podcast. We try to keep it clean and smooth, and obviously we just give you the raw data. We're not like, I'm not saying Zach isn't a professional. I'm saying we're not like the CNBC or MSN studio where we're wearing makeup and doing all that stuff and everything's rehearsed. By the way, most of those stock guys are pay to play to get on there. They interview them for about 4 or 5 minutes, charge them $3,000 so that they can put the little segment on their website, and then they can call themselves a CNBC contributor. Didn't know if you know that. But anyway, the other thing is, each one of these guys talking about these sectors, there's a bunch. We can't hit every one, right? So they're going over the best 2 or 3 that they think are the most relevant. But they do have 3 or 4 or 5 others that they're also tracking. And by the way, sometimes those, because the ones that they're tracking sometimes will pop and get extended before you can get them. But the rest of the group will follow. And so then you can look at one of the other 2 or 3 that haven't moved big yet. So if you got any questions on any one of these sectors they were talking about, we keep it real simple here. We're not super formal, right? My email is dan@revereasset.com. Jackson is jackson@revereasset.com. Ted, same thing. Connor, same thing. Todd, same thing. So if you're interested in that sector that they talked about, right, and they didn't mention your stock, send them an email directly. They can talk. They can bring it up. I mean, given time. Usually kind of want to do that after market hours, because during the market hours they're glued to helping our clients. But anyway, listen, folks, if you like what you heard, please tell a friend, tell a neighbor. Just go to revereasset.com. Up in the right-hand corner, there's a subscribe button for our newsletter. And in this podcast we do every Friday morning normally, right? Zach, our producer, will have it out on YouTube by 1 o'clock normally Central Time. And that's how our stock nerds get it. If you just go to YouTube and just hit Revere Asset and hit subscribe, this will come out before the market closes today. Now, if you're on a newsletter subscription, and they're not mutually exclusive, it'll come out tomorrow morning sometime, right? And you'll be able to watch it then. But every night they do a short market video talking about the overall markets and what we're actually doing in our clients' portfolio and ours, because we're all in it, right? We're the most transparent advisor in the country, I believe, and even in the world. I don't know any other advisor putting out more content than we are. And we're showing everything, warts and all. And always, folks, there's a contact button on our website too. Sorry, I forgot that if you want a complimentary portfolio review, you want to find out more about our process, or you just want a topic or a stock you'd like to discuss on the show. If it's relevant, we'll bring it up. And you can always call us at 855-REAL-WEALTH. Thanks for listening. And remember, it's not their money. It's not Wall Street's money. It's your money.
Because it's not how much you make in the markets, it's about how much you compete.